Imagine it's 15th of October 1923. You're a 42-year-old professor living in Dresden, Germany. Your apartment is full of books, lecture notes, and the small routines that make a life feel solid. Your salary arrives in paper marks, and every week you tell yourself that if you are careful, if you spend only what you must, the numbers will still make sense by next month. Your wife keeps an eye on bread, coal, and tram fares the way a sailor watches the horizon, because prices no longer move by season or by week, but by the hour. You still walk to class in a pressed coat, still speak about language and history, still act as if the country around you is a normal country and not a stage set with shaking walls. And yet, all day, one thought scratches at the back of your mind. If money can lose its meaning this fast, what else can vanish with it? If you have ever wondered why panic seems to appear out of nowhere, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before. And it always ends the same way. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. By the afternoon, even a simple letter feels absurd. In Berlin that same day, Betty Scholem wrote to her son that postage already cost 15 million marks and would cost 30 million 2 days later. A loaf of bread had become a moving target. A tram ride had become a wager against sunset. And men like Victor Klemperer, educated, disciplined, respectable men, were learning the oldest lesson in economic history. Panic does not begin when people scream. It begins when ordinary life stops adding up. That is what this video is really about. Not collapse itself, but the minutes, months, and sometimes years before it. The quiet stretch when governments insist the system is sound, banks promise your money is safe, and newspapers argue over vocabulary while families start changing their habits without fully knowing why. History shows that panic is rarely a bolt from a clear sky. It is more like a bridge giving way after the beams have been rotting for years. The snap is sudden, the weakness is not. Before we go further, there is something important to understand. Financial panic is not magic. It is not mass hysteria floating in from nowhere. It is usually a simple mismatch hidden inside a complicated system. A bank promises you cash today, even though much of the money has already been lent out for years. A government promises a stable currency, even though its debts are growing faster than its ability to pay. A country promises that 1 peso equals $1, or that 1 pound will always hold its value, even while the machinery underneath is buckling. As long as only a few people test the promise looks real. The moment too many people test it at once, the promise is exposed. Think of a crowded theater with one narrow exit. If everyone believes the show will end normally, no one worries about the door. But if one person smells smoke, the door becomes the whole story. Panic is not created by the door. It is created by the gap between how many people believe they can get out and how many actually can. That is why the signs appear early, long before the rush. Banks start paying unusually high interest to keep deposits from leaving. Governments make small rule changes and call them temporary. Central banks invent new programs with technical names that sound calm and expert. Officials repeat the same line again and again. There is no need to worry. The language becomes a fresh coat of paint on a house with wet foundations. And ordinary people, who may know nothing about bond spreads or reserve ratios, begin to sense the tilt anyway. They withdraw a little more cash. They delay a purchase. They buy dollars, or food, or fuel, or anything that feels more solid than a promise on a screen. This brings us directly to Argentina. If you want to see what happens right before panic starts, look at a society where money itself becomes a performance that everyone is forced to keep acting out, even after the audience knows the script is broken. In the 1990s, Argentina tied its peso to the US dollar at a 1-to-1 rate under the convertibility system, designed by Economy Minister Domingo Cavallo. For a while, it looked like a miracle. After years of inflation, the peg felt like a steel ruler laid across a shaking table. Prices steadied. Imported goods filled stores. Middle-class families believed they could save in banks, plan vacations, and think in normal time again. The problem was that the ruler was only straight from above. Underneath, the country was borrowing heavily, much of its debt was in foreign currency, and its export base was too small to earn the dollars needed to support all those promises. When recession hit in 1998, the system did not bend. It tightened. Because the peso was locked to the dollar, Argentina could not easily devalue to regain competitiveness. Because confidence was fading, borrowing grew harder. Because debt was largely in dollars, every doubt became more dangerous. The system was like a shopkeeper promising every customer gold while stocking the shelves with painted wood. By 2001, the strain was no longer theoretical. Deposits were leaving banks. The government was running out of options. The International Monetary Fund was involved. Rumors spread faster than official statements. You could feel the country narrowing like a hallway filling with smoke. Then came 1st December 2001. Cavallo announced the Corralito, a set of restrictions that limited cash withdrawals from bank accounts to 250 pesos a week. That number matters. Not because 250 was uniquely cruel, but because it revealed the truth. Your money was yours until you tried to use it. Then it belonged to the emergency. Look at what happened next. Families who had done everything the responsible way were suddenly trapped. Salaries could still be paid into accounts, but cash was hard to get. Small businesses could not pay suppliers who wanted notes, not promises. Grandparents who distrusted markets and trusted banks found themselves punished for their caution. The middle class, which had treated the bank branch as a vault, discovered it was really a waiting room. And this is where history gets uncomfortable. Panic did not start with the withdrawal cap. The cap was simply the moment the hidden panic became visible. The real beginning came earlier, when the system needed absolute trust in order to function, even though trust was the one thing it had begun to lose. Soon, the streets were filled with cacerolazos, the pounding of pots and pans. President Fernando de la Rua resigned on 20th of December 2001 and left the presidential palace by helicopter, one of those images that looks dramatic because the deeper drama has already happened. Argentina then defaulted on its sovereign debt in late December. In early January 2002, the country abandoned the one-to-one regime. By the end of 2002, the peso was trading around 3.4 to the dollar. The economy contracted by 11% in 2002, bringing the cumulative drop since 1998 close to 20%, and unemployment rose above 20%. But statistics only tell you where the roof fell in. They do not tell you what it felt like inside the house. Ordinary Argentines lived through a collapse in sequence. First came reassurance, then mild inconvenience, then new rules, then humiliation, then anger, then improvisation. Barter networks expanded. People stored cash at home. Trust migrated from institutions back to kitchens, family circles, neighborhood contacts, and whatever could be held in the hand. The survivors were not superhuman. They were often simply the people who understood one fact earlier than everyone else. A fixed promise is only as strong as the dollars, reserves, and political will standing behind it. Once they saw that the peg had become a costume instead of a backbone, they stopped treating it as sacred. Now, here's where it gets interesting. Argentina was a currency panic with bank symptoms. Greece would show the same movie from a different camera angle. Here's something I want you to think about before we go further. If your government told you your money was safe, but also told you that you could only take out a little of it each day, would you still call that safety? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear. And it changes everything. By the summer of 2015, Greece had already been in pain for years. The debt crisis was old news to the rest of the world, but for ordinary Greeks, it was not old at all. It was daily life. Wages had been cut, businesses had closed, young people had left, families lived with a constant feeling of being one bill away from embarrassment. The economy had been squeezed for so long that the country felt less like a nation in recovery and more like a patient being kept alive by tubes no one wanted to look at too closely. Those tubes mattered. Greek banks were depending on emergency liquidity. Confidence was thin. Deposits had been leaving. The European Central Bank later described the situation clearly. There were massive deposit outflows, savers had lost confidence, and the bank holiday and capital controls were imposed to stabilize the system in the short run and protect depositors and borrowers. That is official language. In plain English, it means the floor was beginning to crack under the crowd. Then, on 28 June 2015, Prime Minister Alexis Tsipras announced a bank holiday and capital controls after a surprise referendum call triggered a rush for cash. Banks shut. ATMs became the front line of the crisis. Withdrawals were limited to 60 euros a day. 60. Not enough to feel normal, just enough to feel managed. That number, like Argentina's 250 pesos, became a message. It told people that the system could still function, but only in rationed form. It was a little like being told the ship was not sinking, while being handed one cup of water at a time. The images from Greece are some of the most revealing in modern economic history. Reuters captured long lines of pensioners waiting outside the small number of banks opened just to pay retirement benefits. Think about what that means. These were not speculators, not hedge fund traders, not reckless gamblers chasing yield. These were older people who had spent decades working, saving, and trusting that a pension deposited in a bank was still a pension. Panic always gets sold as a story about greed. In reality, it often lands hardest on discipline. Before the closures, people had already been reading the signs. Cash was being withdrawn. Businesses worried about imports. Families stocked up on fuel and medicine. Everyone could feel that time itself had changed. In a healthy system, tomorrow is boring. In a fragile one, tomorrow becomes a cliff edge. This is the second major point. Panic often starts when a financial system becomes too dependent on life support to survive a shock of confidence. Greek banks were not isolated islands. They were tied to state finances, emergency support, politics in Brussels, and expectations in the street. Once depositors sensed that the chain might break at any link, they did what depositors have done for centuries. They tried to get closer to cash. And notice something else. The official explanation is always about protecting the system. That is not necessarily false. In some cases, the restrictions do prevent a total collapse. But to ordinary people, the meaning is different. A capital control is the state admitting that trust alone is no longer enough. It is a fence erected after the horses have already started running. The human experience in Greece was a narrowing of life. Pensioners jostled in lines. Shop owners rationed purchases. Parents delayed payments. Travelers counted notes before leaving home. A country that used the euro, the shared currency of one of the richest regions on earth, suddenly discovered that membership in a strong system is not the same as personal access to security. This leads to the second part of the lesson. Panic is rarely just about insolvency, which means not having enough assets to cover debts. Often, it is also about liquidity, which means not having cash the moment people demand it. A person can own a house and still be unable to buy dinner. A bank can own assets and still fail on Thursday. A country can belong to the euro and still watch pensioners stand in the heat for their own money. The calm voice on television tells you that technical solutions are being discussed. The line outside the ATM tells you the real story, and once people learn to read that line, the old trust never fully comes back. If Argentina showed us what happens when a currency promise breaks, and Greece showed us what happens when bank access is rationed, Lebanon shows what happens when the entire machine depends on one thing above all else: fresh money coming in to cover old obligations. After the Civil War, Lebanon rebuilt itself on a vision. Downtown Beirut rose again, towers climbed, shops took dollars. The country looked from the outside like a polished casino built beside a fault line. Banks were central to this model. So were remittances from Lebanese working abroad. So was the confidence that dollars would keep flowing in. But confidence was doing more work than people realized. Lebanon had piled up debt equal to about 150% of national output, one of the highest burdens in the world. The economy imported heavily. The political class kept spending. Foreign support shifted. Remittances slowed after 2011. The balance of payments sank deeper into the red. The country needed dollars the way a diver needs air, and instead of coming up, it kept swimming lower. Reuters later reported that by the end of 2015, Lebanon's central bank had negative net reserves of $4.7 billion once commercial bank claims and gold were taken into account. That figure was not made public at the time. Read that again, because this is the kind of detail that matters right before panic starts. The public story was stability. The hidden story was a hole under the waterline. Then came the response. In late 2016, under central bank governor Riyad Salameh, Lebanon began what it called financial engineering. That phrase sounds sophisticated. It sounds like a controlled repair. In practice, it meant offering banks lavish returns for new dollars, which let the state keep financing itself and let banks keep appearing healthy. Reuters described the wider system as something some economists called a nationally regulated Ponzi scheme. A Ponzi scheme is a structure where new money is needed to pay earlier promises. It looks stable until the inflow slows. Then the whole thing suddenly looks less like a machine and more like a magician's sleeve. For a while, the high returns worked. Dollars came in again. People saw the calm front of the building and not the smoke in the basement. Elsewhere in the world, savers were earning tiny returns. In Lebanon, the offers looked generous, but history teaches a brutal rule. When a system must pay unusually high rates just to keep money from leaving, that is not strength. That is distress-wearing cologne. The trigger came in October 2019 when a proposed tax on WhatsApp calls helped ignite mass protests against the ruling elite. But again, the tax was not the true cause. It was the match near the gas leak. Foreign exchange inflows dried up. Dollars left the country. Banks no longer had enough to satisfy depositors. They shut their doors. From that point on, ordinary Lebanese were trapped in a kind of financial theater of the absurd. Dollar accounts existed, but access to real dollars did not. Withdrawals were often limited and paid out in Lebanese pounds at rates far below the market reality. Reuters reported that those pounds lost 90% of their value. So people were being allowed to touch their money only after it had been translated into something far weaker. It was like being told your house was still standing, while the bricks were being returned to you as dust. The World Bank later described Lebanon's crisis as likely among the top 10, possibly top 3, most severe crisis episodes globally since the mid-19th century. Real GDP contracted 6.7% in 2019 and 20.3% in 2020. GDP fell from about $55 billion in 2018 to roughly $33 billion in 2020. More than half the population likely fell below the national poverty line. Smaller depositors, wage earners, and small businesses carried a regressive burden, which means the pain fell harder on those with less power. What did this feel like on the ground? It felt like salaries shrinking between morning and evening. It felt like medicine becoming difficult to afford. It felt like parents staring at tuition bills as if they were written in a foreign alphabet. It felt like bankers, politicians, and central officials arguing over accounting while families argued over groceries. Panic had started long before people pounded on bank doors. It started when the system became dependent on silence. Now look at all three together. The same mechanism, different countries, different decades, same result. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Argentina, Greece, and Lebanon seemed different on the surface. One had a currency peg. One was inside the euro. One ran a dollarized banking model held together by remittances and high interest rates. But underneath, they share the same skeleton. First, each system made a promise that felt simple to ordinary people. Your peso is as good as a dollar. Your euro account is accessible when you need it. Your dollar deposit in Beirut is still a dollar. Second, each system relied on conditions that were much less simple: foreign inflows, central bank support, political discipline, creditor patience, or quiet depositors. Third, each system began showing signs of strain before the public panic. Outflows, rising borrowing costs, emergency measures, unusually high rates, deteriorating collateral, hidden losses, or repeated official reassurances. Then came the trigger. Not the cause, the trigger. A withdrawal cap, a bank holiday, a protest wave. Once the public saw the promise being rationed, psychology changed instantly. That is the pattern. Panic begins when people realize that what looked like stored value was actually a chain of conditions. Break one link and the whole thing wobbles. And this is not limited to those three countries. In the United States, on 16 September 2008, the Reserve Primary Fund broke the buck after exposure to Lehman Brothers debt. A money market fund is supposed to feel like cash with a tie on. When one share fell below $1, the illusion cracked. A week later, Washington Mutual failed after suffering $16.7 billion in deposit outflows since 15th of September. Regulators said it had $307 billion in assets and $188 billion in deposits. In Cyprus in 2013, uninsured depositors at Bank of Cyprus saw 47.5% of deposits above 100,000 euros converted into equity. And Reuters reported that major depositors faced losses around 60%. Different instruments, different legal structures. Same revelation. Access and value are not identical. Now observe what all of these cases have in common. Panic is not the first stage, it is the last stage of denial. By the time crowds form, the true crisis has usually been maturing in silence for years. The public sees the splash. The real story is the leak. At this point, the pattern becomes impossible to ignore. Right before panic starts, three things usually appear together. A promise becomes too expensive to keep. The source of fresh confidence begins to dry up, and some small event finally forces ordinary people to test the system at the same time. That is why panic feels sudden to those who trusted headlines, and inevitable to those who watch the plumbing. But numbers and mechanisms are only half this story. The other half is human. Who pays when panic arrives? Who gets carried under? And who, for all the noise about fairness and sacrifice, manages to walk away in better shape than everyone else? Look back to Germany in 1923. Betty Scholem wrote from Berlin on 15th October that a normal loaf of bread cost 540 million marks, that postage for her letter cost 15 million, and that it would double within days. That is what panic looks like when it enters the kitchen. Not a stock chart, not a minister at a podium, a mother calculating whether sending a letter is worth part of a meal. Hyperinflation, which means prices rising so fast that money loses value faster than people can spend it, drags people on fixed income straight into the undertow. Pensioners, salaried workers, widows, teachers, clerks. They cannot sprint faster than prices because their income is nailed to yesterday. The same was true in Greece. The iconic images were not of financiers, they were of pensioners lined up outside banks, waiting for retirement benefits in a country whose banking system needed emergency restrictions to stay upright. In Argentina, it was the respectable middle class, the people who had trusted the bank account and the peso-dollar promise, who discovered that prudence offered no shield when rules changed overnight. In Lebanon, it was smaller depositors and wage earners paid in lira, along with small business owners, who watched purchasing power collapse while elites argued over burden sharing. The pattern is so old it almost feels cruel. Those who live closest to cash flow get hit first. Shop owners who need working capital cannot wait for policy debates. Families living month to month cannot ride out transfer delays. Pensioners cannot convert time they do not have into better market timing. Wage earners cannot ask the grocery store to accept last month's exchange rate. Meanwhile, some groups tend to suffer less. People with access to hard currency, people with income from abroad, people holding goods that reprice quickly, like inventory, export revenue, or sometimes land. People with flexible networks, foreign accounts, or the social reach to move before formal restrictions arrive. Not always rich people, though often them too. More often, early readers of the weather. Cyprus offered a sharp version of this contrast. Reuters quoted Trophonis Neocleus, a clothes shop owner in Nicosia, saying Cyprus had been paradise and had been turned into hell. Another Reuters interview featured Pantelis Panayotou, a 70-year-old jeweler, speaking with a numb kind of hope after deposit losses and bank shutdowns. You can hear the class story inside those words. These were people embedded in the local economy, holding savings in the local banking system, depending on ordinary commerce resuming. But panic does not treat all forms of wealth equally. A trapped euro in Cyprus was not the same as a free euro abroad. A bank balance above the insurance threshold was not the same as cash in hand. This is why panic feels less like a storm and more like a change in gravity. Everyone is in the same country, but not on the same ground. Some fall through floorboards. Some step onto stairwells they built years earlier. There is another uncomfortable truth here. The people who come through relatively intact are often not the wisest in some grand moral sense. They are simply the ones who do not confuse legal ownership with practical access. They know that an asset on paper and an asset in a crisis are sometimes two different things. That is not cynicism. It is historical literacy. The historical record shows that those who came through these periods largely shared three characteristics. First, they were allergic to single points of failure. They did not keep all trust in one institution, one currency, one employer, or one official promise. Their lives were built like old stone towns, with many narrow streets instead of one giant avenue. If one route closed, they still had another. Second, they respected liquidity and optionality. Liquidity is just a technical word for being able to use something quickly without losing much value. Optionality means keeping choices open. In plain English, the people who survived best tended to avoid being trapped. In Argentina, those with access to cash outside the banking system or income, linked more closely to real goods, adjusted faster. In Lebanon, families with remittances from abroad or business ties outside the local banking maze often had more room to breathe. In crises, flexibility behaves like dry wood in a flood. It floats while heavy furniture sinks. Third, they move before the crowd, not because they were prophets, but because they paid attention to incentives instead of speeches. They noticed when high interest rates were too generous to be healthy. They noticed when governments defended pegs too loudly. They noticed when central banks kept inventing new acronyms to avoid using old plain words. And once they saw that the system needed confidence more than it deserved confidence, they became less sentimental. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. This does not mean they were always richer. It does not mean they never suffered. It does not mean there is some perfect way to stand outside history. Often there is not. But again and again, the record shows that people who understood the structure of the promise suffered differently from those who only heard the promise itself. They also tended to rely on relationships, not just balances. Family networks mattered in Greece. Neighborhood trade mattered in Argentina. Access to relatives abroad mattered in Lebanon. When formal systems stiffen, informal systems become the capillaries of survival. A capillary is a tiny blood vessel. When the main artery is blocked, the small channels keep tissue alive. And one more thing. The survivors were often psychologically boring. They did not need to win the argument in public. They did not wait for full certainty. They did not ask for permission from the mood of the crowd. They quietly reduced exposure to fragile promises whenever the signs became too obvious to ignore. That is not advice, it is observation. History is full of people who survived not by brilliance, but by refusing to confuse normalcy with safety. So let us return to Dresden, to Victor Klemperer, walking through a city where money had become a hallucination with official stamps on it. The Panic of 1923 did not begin on the day prices went wild. It began earlier, when numbers stopped meaning what people thought they meant, and the state kept trying to bridge the gap with paper. Klemperer lived through that season of insanity. Germany stabilized later in 1923 with the Rentenmark, and the daily frenzy eased. But stabilizing the notes did not erase the memory. Once ordinary people learn that the floor beneath everyday life can split open, they do not forget it. That is the final lesson. Right before panic starts, the world still looks mostly normal. Stores are open, apps still load, salaries still arrive, politicians still smile. The danger is not obvious because it hides inside routine, but the pattern is there if you know where to look. A promise that depends on perfect confidence, a shortage of real liquidity behind easy words, a leadership class buying time instead of solving causes, a public that senses the truth before it can fully describe it. History shows that panic is rarely born in chaos. It is born in the long, quiet mismatch between what people are promised and what the system can actually deliver. The scream comes later. First comes the whisper. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.